Greetings, everybody. My name is Frank Bush. I'm President and CEO of Kelso Technologies. We are in the rail tank car valve business, so we follow the rail tank car market very closely. If you were to squint and read all this, you would think my lawyer doesn't like me. Feelings mutual every time I get the bill. But we do ask that, although we try to do some of the heavy lifting for you and some of the math here, to certainly verify, and investment is inherently risky and all that. I'm sure you're all aware. Oop, too far. So we're going to go through a few things here. I'm going to speed up the pace a little bit, just in the interest of time and getting us all back on track here. At a glance, we follow the main industry economy, particularly in chemical shipments. So we project the rail tank car market to be growing at this time. We've certainly been through ups and downs. It's certainly a cyclical market. But we're also looking to expand into new markets and to gain market share within our existing market. We had a major changing of the guard last year. We have an all-new management team. Our board has changed dramatically as well. And we just wanted to return Kelso to profitability. So we had the crazy idea to increase revenue and decrease expenditure. And it seems to be working. Our adjusted EBITDA is up 200% year over year, and our net comprehensive income is up 139%. So we're strategically positioning the company now to focus on growth, now that we've got our house in order and are returning shareholder value. It's not a new company, originally established in 1987. We've been in the tank car market for quite some time. Our main facility is in Bonham, Texas, which is about an hour north of Dallas. We have access to very good skilled labor in that region, not just from North Texas, but also from Oklahoma as well. Our equity value currently about $9.7 million, which we believe and would like to explain how we are very much underpricing in the market at this time, for some good reasons and for some not so good reasons as well. The tank car market, highly cyclical. We hit a major peak in 2019. I believe about 20,000 valves were delivered in that year. To date, we've shipped over 100,000 valves, generally in pricing anywhere from the neighborhood of $1,500 to $2,500, depending on kind of what bells and whistles are on it or with it. And we've had no LTIs in 9 years. So we're very happy about our safety record, and we stand by our products as well. Everything is 100% made in the USA with 100% local labor, and also all of our components are sourced, vast majority from within about 200 miles of our plant in North Texas. Now we're currently highly correlated to the tank car market, and there's a lot of data out there where you can review projections for new tank car builds, all based on chemical shipping in the US, which we'll speak to as well, is increasing. In the macro environment, we've seen a fairly dramatic increase in US chemical shipments. I think it's directly correlated to onshoring manufacturing in the US. Nobody's really looking at the chemicals so much because they look at the tank car builds and that, but we're tied to that very closely. So this past July, we saw these chemical shipments increase to the highest level since 2008. So that's very exciting for us because it means that we could be looking at greater deliveries of tank cars and in the same process and for the same reasons, being able to increase our market share. A lot of this stuff is non-discretionary, like it has to move. These chemicals are needed in plants across the United States, and they usually have to move from A to B. And the more they do that, the more wear and tear you get on the tank cars, and the more replacement tank cars you get ordered. There's major barriers to involvement in this industry. There's a lot of regulation. There's a lot of bureaucracy that keeps new competitors out. Even though we're founded in 1987, we're still considered the new kid on the block. This market's very resilient as well, so we always know there's a certain minimum that we can look at every year. Our outlook in the macro environment is very positive, and we are actually seeing a lot of opportunity as companies, global companies particularly, and those outside the US are looking to how can we improve our imprint in the US and to be compliant with the Build America, Buy America, or what we call BABA laws. It is a double-edged sword though. I don't agree with tariffs, I agree with free trade, but what we're seeing in a lot of cases is that while there's an onus to buy more from the US, a lot of our big customers have some of their production facilities in Mexico. So it does help us, but it also hurts us at the same time. But we're just kind of looking at where can we take advantage of tailwinds as they occur. And we're kind of operating on the theory that whatever is happening with tariffs probably won't end anytime soon, even if there were a change of government in the U.S. Once the government gets stand on a tax, they like to keep it. We estimate that we have about 30% of the tank car market currently. We're always kind of looking backwards at that on tank car deliveries, just looking at how many we produced and how many got produced. We've made a major shift in our sales processes now that rather than kind of exclusively dealing with the 4 big OEMs that make the tank cars, we're now looking at the end customer, because the end customer is the one determining which product will be shipped, and we're encouraging them to spec the Kelso valves in the case. We don't compete on price, is kind of the big change here, is that we compete on quality, and we stand by our products with a 10-year warranty. So we're also able to deliver within 2 to 4 weeks. Most of our competitors, it's about a 9-month lead time, and in the case of our biggest competitor, there's often missed deliveries, and we do get calls from our customers saying, hey, these guys failed to show up, can you guys make us something in the next little while? So we want to seek more opportunity to improve that market share, changed up our sales strategy significantly, focusing on the end customer. We do see market upsides. Currently, there's about 440,000 tank cars in the North American fleet, 100,000 carrying Class 3 flammable liquids. We do hazmat as well as non-hazardous as well. This year, we're projecting just over 10,000 new tank car builds. Next year will probably be fairly similar, fairly flat. But then what we're seeing forecasted due to changes in regulations and decommissioning of old tank cars, that we'll start seeing an increase again in 2027. So we're kind of seeking to not only increase our market share, but increase our capacity to be able to deliver on those and be ready for the 2027 tailwinds that we're seeing. In the meantime, too, we can see that we can enter into adjacent markets with very little capital outlay. We're exploring different opportunities to go into other adjacent markets. We're just looking at hey, what do we do? How do we do it well? What are we known for? And can we enter in those markets without much outlay of capital? So we are exploring those, and very likely that'll happen by way of potential joint ventures, likely with companies outside of America who want to onshore their production. We do have 2 new valves in the pipeline, currently going through the process with the Association of American Railroads. We have our angle valve, mainly used for LPG and anhydrous ammonia, where the angle valve will complete our pressure car package, because we're seeing a bit of a loss of market share because we don't provide everything for our pressure car, particularly in the angle valve. The other nice thing about the angle valve potentially is that a lot of the tank car configurations require 3 of them. Whereas with our pressure relief valve and our vacuum relief valve, it's only 1 that is needed. So in completing the pressure car package per tank car, we would hopefully go from making $2,500 a tank car to about $10,000 by adding those. The bottom outlet valve is for other types of commodities, particularly those that are highly corrosive. Currently in the market, it's kind of steel on steel, and then whatever the material is, usually it's hot asphalt or molten sulfur. Gets into the components and really destroys them. So that's why I think you need milled steel. That one will be a little further out because those types of shipments are less frequent, and in order to achieve the loaded trips and miles to qualify for the AAR approval, will take some time. But we are hoping to have that angle valve out over the next fiscal year. The bottom outlet valve is probably likely going to come online closer to 2027. So we are pushing that process, and we've kind of refocused to get those approvals, and that'll drive our kind of more organic growth. Now we're seeing opportunities in the market, and largely due to changes in the policy in the United States. So we're seeing a lot of the production that was happening in, say, China and India now trying to onshore into the US, and we're seeing opportunities that, hey, we make some of the best valves in the world, why not go into those other markets? Because we're currently exclusively in the rail tank car market. So we see opportunities in water and wastewater, oil and gas, chemicals, pulp and paper, irrigation, and desalination and power plants. And I think I saw a desalination company here yesterday, so I want to get talking with them as well. So that's kind of what's happening new, and I believe will drive the future of growth for Kelso, is kind of looking at like what else can we be doing. I believe our factory is currently operating at about 35% of its capacity. The number of valves we made in 2019, we have roughly the same team, and we've kind of fought hard through the COVID-19 pandemic to maintain our team. Bonham's a fairly small town, I think population of 10,000 people, and everybody knows everybody, so we wanted to avoid big layoffs in that area, especially if it gives us the opportunity to scale up quickly. Rather than having to get orders in and sort of try and train new people, we want to avoid that. We've had a very good first half of the year. We kind of went right back to basics last year. We had to look at everything we were doing and just kind of decide, okay, what is bearing revenue and what is not bearing revenue. And I think the results are showing that we've done a fairly good job. I believe we still have some pencil sharpening to do. We're still constantly trying to find efficiencies and reduce cost wherever we can. But now I think we're getting much better positioned for growth. It's a little bit more financial metrics for you. We really just kind of focus on looking at everything. We've had third-party verification of some of our data and that, but really we came up with the magical idea to increase revenue and decrease expenditure, and it's starting to bear fruit. So we, in our new direction, first thing was we had to cease operations in some of our research projects where the line of sight or the runway was too far out. Pre-pandemic, obviously we had a little bit more money to play with. We had a little bit more opportunity to do research in that. We had to reassess and say, okay, what is it we can do better? And if we, get better at what we're doing, if we see more profitability, I'd prefer to grow through acquisition of IP or potentially even acquisition of smaller private companies rather than doing the research in-house, which has proven quite expensive. So I think our expansion, particularly we have low-hanging fruit into trucking. We actually do have a trucking valve. We just haven't pushed into that market as hard as we could. So that's going to be a new thing for 2026 is to enter into that market and then exploring opportunities where we can work with potentially other companies, joint venture partners, and move forward that way. Now, when we did the analysis of our valuation of our stock price compared to industry peers, we had to look at other companies in our field. Trinity and Greenbrier are actually our two biggest customers, and the Dorver Corporation, through its wholly owned subsidiary Midland, is our biggest competitor. So then we looked at other small industrial manufacturings, and we ran the numbers on the EV revenue, EV EBITDA, EV gross profit, and price book, and saw that we are very much mispriced in the market. Just looking at the median here, just look at comparables. This is available on the website if you want to take a deeper dive here. But just looking at how our share price is in comparison to those of our peer group, we are very much underpriced. I'll leave you to speculate kind of where our price should sit. But based on these metrics, we're below almost all of our peer group. So current market capitalization about 9.7 million. So across the four metrics that we assessed, we see we're particularly under EV gross. We're potentially grossly underpriced. So I believe there's room to move in our share price. And what we're seeing there, I think once we hit that median level, then I think that's where we can take a good look and reassess where we're at, how we can drive more shareholder value. But that's kind of what the big refocus has been on, is how to improve not only liquidity in the stock, but also in the stock price as well. So we have very strong margins, generally about 38 to 40% gross margin. It's a kind of a widget scenario. We get components from all over the place, all within the U.S., and we put together product for the client. We do some welding in-house. We have a weld shop, but we don't do any really heavy manufacturing. So it's mainly assembly, warehouse, distribution, logistics, things like that. The return to profitability was really great. I don't think we had a profitable quarter since 2020, Q2, I think Q1 of 2020. Just a big part of it was the COVID-19 pandemic and some of the upsets that happened in the supply chains. But then, also was, looking at how we govern ourselves and how we do things. And we've kind of done a major reset on that. I think we have great strength in our location in North Texas. We're right close to kind of all the big players. I think our biggest customer is about 200 miles away. And there's now value to that. We've always promoted ourselves on 100% made in the USA. All of our revenue is in USD. But until recent policy changes, that wasn't a big factor for our customers when we asked them, like, how important is it to you? So even this time last year, they're telling us, well, it's not, for us, it's cost generally and what our end customer wants. And that wasn't a big factor. Now we're coming back and like, hey, this BABA thing, the tariffs, it's a big deal now. So, we've always had that focus of 100% made in the USA, but now it's actually starting to bear fruit where it hadn't previously. We have a clean balance sheet. We have no debt, and we're looking at what can we do, how can we grow, and I don't think it would take a whole lot. Because if we do things that are closer in adjacent markets, we won't have a big outlay of capital to do that. Our equity, our implied cost of equity is quite high, about 16%, whereas we're able to borrow at closer to 8%. So we'll have to make some decisions there, just depending on what we do. But we have access to debt if we should need it in order to enter those adjacent markets. But I don't think it would take a whole lot. So we've done these calculations, and we'll continue to monitor this quarter over quarter as we start kind of into those discussions about what else we can be doing to add shareholder value. Go over this here. Again, like our whole team has changed. So, myself, our new CFO, Samir, and we promoted Amanda, who is the plant manager, to our COO. We've had a change at our board level as well. Jesse Cruz has taken over as our lead director or chairman. He's just a wonderful guy, 40 years of experience in rail. He was in senior positions, C-suite positions at GATX, which is one of our big four customers, and at Trinity, which is our largest customer. So we've kind of had a refocus on fundamentals and how to improve those fundamentals, and so we can actually talk to investors and say this is what we're doing. Mark Temin is our new director. He's got a lot of experience in growing companies and scalability in that, and he's been a wonderful addition to our board that way. So whole new team, whole new outlook, doing things very, very differently, and an old and established company. Our shareholders have been buying. Myself, I've increased my position by around 600,000 shares bought in the open market. When I was previous to that, I think I was holding about 20,000 shares that I bought at around 75 cents. So I've really averaged down, and I've tried to advise where possible my existing shareholders, like, this is the time to average down. But I believe we'll all be increasing our positions here because we still see value. We see that things have turned around, and we're going to be on the upside here, and I certainly invite everybody to join us in that. So our big catalysts, obviously, cost discipline. We've become very cheap. I grew up poor, so it kind of comes very naturally to me to do things that way. Just look at everything. Nothing's too small. I want to know where cost savings can be found, and we do it. We want to be able to leverage, particularly our location, our kind of our American connection. Canadian domiciled company with operations in the U.S., trading in U.S., operating USD. Bringing on those two new valves are going to be a big part of our organic growth, but for me, not enough. We need more growth than that, so that's going to have to come from deploying into adjacent markets and seeing what else we can do. And obviously we have some capital structure flexibility as well. So we consider ourselves a rare opportunity. We'd dug ourselves really tightly into a particular niche in the rail tank car market, and you kind of had to because of the regulatory scenarios there. It's kind of all you can do, but we just focus on how do we do that very well, and we've achieved that, I believe. And so now we're able to start branching out a bit. So we have clean capital structure. We have capacity for leverage. We've been having investors coming to us say, hey, you guys want to do something? We'll help you raise capital in that. So it has to be the right opportunity, though. We're extremely conservative. We learned it kind of the hard way. So we're very focused on making sure that whatever we do is the right opportunity. And I think that's about it.